Good afternoon, everyone, and welcome to today's webinar on long-term care. I'm Ryan Boucher, and we appreciate you taking the time to join us today. You're familiar with our quarterly webinars where we typically discuss the markets and the economy, but we want to do more of these webinars around planning topics. So for today, we are joined by Brian Johnson of Advisors Insurance Brokers. Brian is an expert in long-term care planning. He has a wealth of knowledge and experience. We refer our clients exclusively to Brian because of the trust and care he provides those who he works with. Towards the end of the presentation, we'll also share Brian's contact information so you can contact him directly or any of our advisors at Boucher Financial Group to connect you with Brian and open up the dialogue. So with that, why don't we start our presentation today? So today, Brian's going to walk us through an asset allocation approach to long-term care. There's going to be a lot of good stuff here, and excited for him to share that with us. We'll go through 2 pages of disclosures before we get started because there are some products that are specified here. And before I do turn it over to Brian, I just wanted to share this stat. I thought this was really interesting, and I think it brings home to me just what long-term planning is, because it's not always just about the cost of it. It's really about the type of care you get. And in seeing this, the 77% of people would prefer to receive care in their own home. It's such an important stat, and that's why planning appropriately for what you want and what's important to you is key here. So with that, I'm going to turn it over to Brian to get us started with today's presentation.
Yeah, absolutely, Ryan. Thank you, and thanks to everybody for tuning in today. We really want to talk about long-term care because, as you know, Ryan, it's really part of the retirement planning process. It's when we talk about retirement, a lot of the onus is always put on accumulating assets, saving for retirement, and that's certainly part of it. But it's also protecting that retirement, and we have to look at the risks that we might face in retirement. And when you're doing your planning and you're stress testing your portfolio against different risks, long-term care is one of the biggest risks retirees will face. To kind of look at long-term care and to define it, it's really defined as anytime I need assistance or supervision with my everyday activities of daily living, eating, bathing, dressing, toileting, maintaining continence, and transferring. A lot of people are under the assumption that long-term care means nursing home. And that's true, it's part of it. But the good news is, I think the good news is 80% of all long-term care is actually received either in home or in the community, like assisted living. And most of the time, the primary caregivers are informal caregivers, which could be either, spouses, domestic partners, adult children. And, that's really what long-term care is. So if people really think long-term care is nursing homes and they say, I'm never going to a nursing home, then I don't need to plan for this. And that's just not true. That's not what we see. That's not the right way to kind of think about it. You can go on to the next one, Ryan. So there's your 6 activities of daily living. And if you do have a long-term care policy and you're listening today, the assistance or supervision with 2 of these 6 activities of daily living is how we access the benefits of a policy. That's the trigger, or a severe cognitive impairment like Alzheimer's or dementia. And I don't care what policy you have or which one you're looking at, the benefit trigger to these policies for long-term care is the same from policy to policy. We have to look at the costs, obviously. We have to look at the cost of care. And, you can see here, these are national. But when we talk to clients and start having a conversation about this, one of the questions we want to know is, where do you plan on living in retirement? Some people may not know. Some people say, I'm getting out of New York and I'm never coming back. But, that will impact the plan that we put in place. You can see here in 2018, about $50,000 a year is the average cost for home health care. Assisted living a little bit less at $48,000. Nursing home about $100,000 a year. And I can tell you, in our area, these numbers are light. You know, a nursing home for a private room in our area right now is probably closer to 140 to 150,000 dollars a year for a private room, private pay. So again, certainly something that we need to look at. And again, you know, the way to think about it is, well, you know, when you're planning for retirement, you know, it's the fear, I guess, is not outliving your money. The fear is, or not the fear, but the goal would be to do other planning, you know, whether it's legacy planning, philanthropic planning, whatever it might be. Well, how do these costs impact that plan? Okay, what are the consequences to my financial plan, but also to my family if me or my spouse should need long-term health care? The next one.
I think
So there's
I like this slide to get us into that next level of discussion because this is a big part of the conversations that we have in understanding how this type of coverage is paid and whether you have health insurance or rely on Medicare or Medicaid. How does that play into the long-term care conversation?
Yeah, and there's some misconceptions out there. And if you're not on mute, you might want to just mute your phone as well, or computer. But there's you know, some misconceptions, you know, as to what covers long-term care and what does not. You know, a lot of people are under the assumption that either health insurance or Medicare will cover long-term care, and you know, it's I understand why people would think that. Certainly, if you've been through an experience with a loved one where, you know, if the need for care is a short term, and when I say a short term, that's typically less than 100 days. Typically, between Medicare and health insurance, we do have some coverage for long-term health care. And Medicare and health insurance are really designed to cover rehabilitative care. Medicare defines rehabilitative as 100 or less days. The predicament people get into is day 101 and beyond. So once Medicare stops paying, once health insurance stops paying, we may assume that we may transition to Medicaid. And, you know, Medicaid does cover long-term care, okay? But that was never the intent of the Medicaid program. Medicaid is a means tested program. And when I say means tested, it means that we have to qualify financially. So in New York State, you know, Medicaid is different from state to state and even by county by county. But Medicaid in New York State, typically, if I'm part of a married couple and we have more than around $74,000 in assets, we don't qualify for Medicaid. The income requirement, closer to around 3,000 per month. So if our household income is greater than 3,000, we don't qualify for Medicaid. You can see this slide here, it says assets of 2,000. That's the case in most states. So again, something to look at when you are retiring, where you plan on living in retirement. I think most of us will agree, though, that you know, you have to be at the poverty line, and that's what it is. Medicaid is a welfare program, so you do have to be at the poverty line in order to qualify. A quick little piece on Medicaid: it's not a bad program; it's a good program, but we need to understand how to qualify for it and what it covers. You know, so we always advise, you know, when you're putting together a long-term care plan, look at your options, and the options are really going to be paying out of pocket or using liquid assets or your income, using some type of insurance, which I'll talk about in a moment, or doing Medicaid planning with an attorney. And that would involve setting up an irrevocable trust and transferring assets to that trust 5 years in advance. And then if I do that, technically on paper, I'm at the poverty line, and you may qualify for Medicaid. Or we use a combination of those strategies. You know, a lot of people will set up a trust really just to cover the catastrophic because, again, Medicaid primarily pays for nursing homes. It's very limited for home care in New York State. Outside of New York, it's no home care, and it's zero assisted living, regardless of where you live. You know, so the options that you have under Medicaid are few and far between, and they're getting less and less as the system is kind of getting squeezed. You can skip to the next slide, right? So some of the things to consider in putting a plan together, you know, it's very much I think a family discussion. And I think that's, if there's one takeaway today, it's don't be afraid to have a discussion or conversation, certainly as we get closer to the holiday season. I know we're not going to be congregating and having these big family dinners this year due to COVID, but that's typically when these conversations kind of come up. It's, oh, did you notice mom or dad is getting a little forgetful, or maybe somebody fell. That happened in my own family recently. I'm going through it right now. And don't be afraid to have these conversations, because you can't assume or guess what your loved ones are thinking. I have some clients say, well, don't, if I ever need care, my son or my daughter said they'd help out. Okay, well, is that really what you want? And do your son or daughter know that that's your plan? We need to have these hard discussions. But sometimes that's the case. You may have a lot of children. Children can step up and help out. It's also important to kind of take inventory of your assets and your income, and also what debt obligations you might have in retirement, because you may have disposable income or certain safe money assets earmarked to help cover the cost of long-term health care. Besides the money side of it, what impact will this though have on my family and my loved ones? A lot of people come to us, and the initial conversation or reason they come to us is because they want to protect their assets, or they might want options for their health care if they ever need it. But the number one reason people plan is really because they don't want to be a burden to someone else. You can skip to the next one, Rye. So here are your basic insurance options. Again, insurance is not right for everybody. It's just not. But it's appropriate in some cases. Our goal today, or at least my goal, would be to at least encourage people to get educated and put together a plan, or start thinking about what that plan will look like, whether it's doing Medicaid planning, insuring some of the risk, or helping to identify some assets and income that you could use to pay for these services if you ever needed them. If we're talking the insurance part of it, we have three basic options. There's a life insurance policy with a long-term care rider, and these are pretty new. And in a lot of companies, we represent 13 or 14 insurance companies that include a long-term care rider on a regular whole life insurance policy or a universal life insurance policy at no cost. So a common planning technique that we typically use is certainly take older life insurance policies that may have accumulated some cash value and transfer that cash value into one of these newer generation of policies that includes long-term care coverage. I'm going to skip over the middle one for a moment. The standalone policies are your regular, plain vanilla, traditional long-term care insurance policies. They're filed as health insurance policies. The sole purpose of them is to provide home care, assisted living, or nursing home benefits. There's no residual value, there's no death benefit to these policies, but for that reason, it's usually the most cost-effective way to get comprehensive long-term care protection. What I'm really focusing on today in this conversation are the linked benefit policies. And that's really why we titled the presentation an asset allocation approach to long-term care. You can skip to the next slide, Rye. Actually, why don't we skip ahead one more? All right, so these hybrid policies are really designed, for the ultimate in flexibility, ultimate in choice, and in familiarity. And the reason being is, for the long-term care, if you ever need to use the policy for long-term care, the reason we like this type of policy is the benefits are payable to you in cash. Now, with most traditional long-term care policies, I typically have to pay for the cost of my care out of my own pocket. I save the receipts and I send them into an insurance company for reimbursement. I typically have to use licensed or certified providers, and they do the job that they're intended to do. It just takes some more accounting work, and it might limit as to who I can use to provide my care. With this type of policy, again, the benefits are payable on a cash basis. So it's a cash indemnity benefit. If I have $6,000 or $7,000 a month of insurance benefits coming to me each month, I receive a check tax-free for that amount. I can pay the insurance to my spouse, my kids, pay someone to drive me to the doctor or the grocery store, someone to mow my lawn, or I can pay it to licensed providers or the assisted living. It's just a much more flexible type of policy. You can skip ahead one more.
Certainly, and Brian, I'll just chime in.
Yeah.
Since you've educated us on these types of policies, long-term care seems to be the one insurance where, with any insurance, hopefully you don't need it, but with long-term care, it's always that insurance where, folks hate wasting the money on it. Whereas, like, when you do waste money on insurance, again, it's kind of a good thing when you don't need insurance, but because
Right.
this can typically be so costly, this is definitely an area where there's just that feeling of not using it or throwing the money away. It's hard to get over. Where there's a lot of we like these policies in terms of how they can kind of help bridge that a little bit.
Yeah, you're absolutely right, Ryan. And that's one of the reasons they were kind of developed. And you can see on this screen here that some of the keys to this is home sweet home is really talking about where most people want to receive care. So how do I stay home as long as possible? Well, if I have a very flexible insurance policy that pays me cash, well, then I'm going to have much more options to bring in the providers that I need. A guaranteed death benefit is kind of what you were referring to just a minute ago, Ryan, is, if I never need the long-term care part of this policy, my beneficiaries are going to receive a tax-free life insurance death benefit. The premium is guaranteed as well. With some traditional policies, if you're listening today and have a traditional policy, again, I think they're great to have them. But might be some volatility, if you will, in the premium, right? It's not a guaranteed premium on a traditional long-term care policy. It is a health insurance product, so premiums can go up over time, and you may have experienced that happening. That can't happen with this type of policy, as it's a guaranteed universal life insurance policy. So we have a couple of things, a couple of different ways really to fund or pay the premium for this type of policy. We have multiple options, and you also have multiple inflation protection options, because again, if we're planning for something that we may not use in 20, 30, 40 years, we want to make sure that the benefits are going to grow over time. And we have a whole different array of inflation options that you can add to these policies, just like a traditional long-term care policy has. But in terms of how we pay for it, and if you want to skip to the next screen, Ryan, we can see that we have a whole host of different ways to fund the premium. And again, this is why we're talking about as an asset allocation approach to long-term care planning. You can see here there's a few different options. We have a single premium payment. You pay one time, which is all the way on the left there in that dark green. You can pay every year for 5 years, every year for 10 years, or if I can pay till I attain age 65, or I can choose to pay the premiums over the course of my lifetime to age 100. We see most clients fund these policies either in a single premium payment over 5 years or over 10 years. Now, funding them with a single premium payment, it's a much higher premium because you're condensing that down into just one payment. But where most people are actually kind of funding these from are from like a safe money asset that they might have. Very quick case study. We had a client a few days ago that had $250,000 in CDs. When we asked what that money was for, they didn't need it for income. It was kind of their rainy day. It was their emergency fund. And we asked, well, what's the emergency? And 9 times out of 10, that emergency is healthcare related. So these clients had kind of, earmarked that $250,000 in CDs to pay for long-term healthcare if they ever needed it. What we were able to do is reposition just $75,000 of that $250,000 and transfer it into a single premium payment into this type of policy. When we did that, from day one, it created almost $400,000 for long-term care. The death benefit on the policy was about $140,000. So if they never need long-term care, the beneficiaries get the $140,000. If they do need long-term care, now they're not just limited to $250,000 that they have in their CDs. We have $400,000, and they're able to go off and put that additional money they had sitting in the CD to work. They can be a little bit more aggressive with it if they want, because they don't need to have the whole 250 earmarked for long-term care anymore. So, it's kind of just repositioning a safe money asset that might not be needed for income. We don't want to fund these types of policies if there's going to be adverse tax consequences, penalties for withdrawing anything from like a retirement account. You don't want to do that. It's again from that safe, lazy money, we say in air quotes. Or the premium can be paid again over 5 years, over 10 years to 65, and it's a much lower premium, obviously. You can skip to the next one. So again, it's a flexible policy. One thing I'll bring up on this screen is the asset does remain liquid into this policy as well. So if I am transferring a single premium into this policy in a lump sum using that $75,000 example, this policy also has a feature where if I ever needed to get that $75,000 out of the policy, I can do so through a refund of premium rider. It would cancel the contract, obviously, but I would get almost 100% of my premium back if I ever needed it. So some flexibility there. Let's skip to the next one. Again, some more benefits. The one we're talking about here is through Nationwide Financial. It's not a commercial for Nationwide by any means. They are one of the many companies that we represent. They do have this policy. Again, the reason we like it is because the policy pays the long-term care benefits in cash. Again, many of the competitors, it's a reimbursement type policy. This does not. Again, I can use the funds however I see fit. And again, a tax-free death benefit. If I never need long-term care at all, my beneficiaries are still going to get the money in the form of that life insurance benefit. Next one. Quick example here. You can see, this is a $250 a month premium, and it kind of shows how the policy is built. We won't get into all of it, but this is designed to pay the premium until age 100. We have a 3% compound inflation rider on it. But the quick math I'll just point out is, from day one, so from the first day that this person enrolls and pays their first $250 a month into this policy, they have $346,000 of long-term care benefits. That $346,000 grows when this person is age 80 to be over $1 million of long-term care coverage. So you can see that the compounding effect and the growth of the policy really increases the amount that we can draw from long-term care. And we have the flexibility not just to do that big single premium payment, we can also elect to pay a monthly premium over my lifetime to fund this type of policy. Next one. Some little things to point out. You do have access to caregiver support and a care coordination with this type of policy. It's one of the best features of a long-term care policy. If you have a traditional policy, it should include that as well. And a care coordination service at claim time helps the insured individual, helps the family member understand the policy, expedite the claim, and then helps locate care providers if the family needs that assistance. So yeah, great, we have an insurance policy. What do we do now? Well, that's where the care coordination service comes into play to really help that family through the claim and put the right providers in place. Next one. And that looks like it's pretty much the presentation in a whole. I like Ryan said at the start of the presentation, I'm happy to have a conversation with anybody that wants to kind of review their plan that they may have or look at options. If you have other advisors, I'd certainly say we're happy to speak with them as well. Our office, we're completely independent, but we've worked with Ryan, Steve Boucher, Marty, the whole team at Boucher Financial for quite some time. And we're really big proponents of coordinating the plan with your other planning. You don't want to kind of plan in a silo. You want to know, you want the other foot to know what the other foot's doing, if you will. And that's what we do with Ryan, Marty, and Steve on a regular basis. So Ryan, with that, I appreciate the time today, and I appreciate everybody carving out some time to listen in. I kind of went quick because I was trying to be just sensitive of everybody's time.
Yep, Brian, I have a couple. I didn't see any questions come through the chat. As I said, if anyone does, we can take a question or two. But we have Brian's information here, and you can always reach out to us to coordinate it. I think there's a lot of options here with these types of policies, and again, it may not be for everyone, but there may be a way to have that work. Two things that come up for us a lot too, Brian, with these long-term care conversations is for someone listening or someone who's interested, what's generally a good entry point from an age range, especially on like a policy like the one you described today?
Yeah, our average age, Ryan, I can tell you the average enrollment age of any type of long-term care product is around 58 to 60 years old is what we typically see the most. Now that's come down quite a bit in my 14 years in this business. We're always proponents of planning earlier than that, though. Because someone in their 40s, early 50s, if you're listening and you might be in your 60s, 70s and have adult children, the younger you are, the more options we have from both a cost standpoint, but then also insurability. You have to remember because these are medically underwritten policies. And whenever someone calls in and says, I'm interested in long-term care, my first question is always why? And it's either I get one of two answers. It's either I'm going through something now with a loved one and I don't want to do that to my kids or my other family members, or I was diagnosed with something. And unfortunately, sometimes a diagnosis may prevent someone from obtaining an insurance product. So younger the better. You always pay less over your lifetime. The younger you are that you start is typically how it works. But our average age is probably late 50s.
That's great, and I think it's a good point in terms of just the planning process, that it's never too early to at least get the information or
Exactly.
learn more about what the options are, because like as you said, just that flexibility gives you so much wiggle room here. So I think it's good to, again, if it's something that you're considering or it's top of mind, we can help coordinate this meeting or with Brian's information. Feel free to reach out to him, and we can work closely with Brian in terms of your overall planning needs and what makes the most sense. And we've done that in the past for other clients. And like I said, when you're doing any planning meetings with our advisors here, it's something we can certainly touch upon and explore in more detail.
Yeah.
All right, Brian. Well, I appreciate you joining us today. Thank you for this information. And as I said, anyone who has any follow-up questions, please feel free to reach out to me, any of our advisors, or Brian directly. And Brian, thanks again.
Yeah. Thanks, everybody.
All right.
Thanks, Ryan. Take care, guys.